cash flow problems are a leading source of stress and missed opportunities for small business owners. This is often due to lack of planning, when there's still time to manage your cash to avoid a crisis. The most powerful tool to manage your cash flow is a cash flow projection. It allows you to identify potential future low or negative cash balances while you have plenty of time to take steps to avoid a cash crunch. It also allows you to time when you can grow or capture opportunities to take large amounts of cash. I'll walk you step by step through how to use a simple Excel cash flow projection. First, let's take a quick overview of the sections of the cash flow projection. This cash flow projection follows the standard sections of a historical statement of cash flows. It starts with your cash balance. Next, we start with your operational cash inflows and your operational cash outflows to get net cash from operations. The next two sections are your financing and investment cash inflows and your financing and investment cash outflows. This leads to your net change in cash. Your beginning cash plus or minus your net change in cash becomes your ending cash balance, and that ending cash balance becomes your beginning cash balance for the next period. So now let's walk through each of the pieces of this. The very top are the dates. And you can enter 5 different periods for this cash projection. And that could be 6 days, 6 weeks, 6 months, 6 years. Or you could just do a 5 year projection and not use the sixth column if you want. For this, we're going to be doing a 6 month projection. So let's enter in the first 6 months. You may have noticed when I entered the first date that when you hover over certain sections or certain cells, you can see help on how to enter different things in this cash flow projection. So as you're going through it, this gives you tips and guidelines on what to put in each of these areas. You can see the cells that have help for you either with the purple or with the red triangles up in the upper right hand corner. The other thing I built into this cash flow projection is protection so you can't mess things up. So you'll notice that you can enter in a beginning cash amount in this. And so for this, let's assume we begin with $100,000 of a beginning cash balance. If you try to enter anything in the other cells, you can't because the beginning cash balances are based off of the cash inflows and outflows you're going to put in for each period. The other thing you can't override is to try to click onto any of these cells here, except the other cells, because those ones you can enter in exactly what you're putting in. And those other cells gives you flexibility so that you don't have to use the default values or the default row amounts. You can enter in exactly what you want for your particular company. One question you may have is where do you get the information for this cash flow projection? One way to do that is to run a cash basis income statement month by month or a cash flow statement from your accounting software. If you can't run that, run an annual basis income statement and divide that by the total number of months. Now let's start entering in some amounts. Let's assume your sales for the first month are $250,000. Now, in addition to your sales, if you're in a state that collects sales taxes, you'll also have to collect the sales taxes. Now, it's better to put your sales tax in as cash collected and then down in operational cash outflows when you remit the taxes because you'll be collecting the cashes monthly, but you may only have to remit the taxes to the state once a quarter. And that is an important thing to model in your cash flow projection. If your sales tax collected and sales tax remitted isn't that big and it occurs on a monthly basis, you could just include it in the net it out of your cash from sales. Now let's go to the operational cash outflows. The biggest cash outflow you have if you have goods that you sell rather than services are your cost of goods. So let's assume that you have $125,000 in cash paid for goods. The biggest expense outside of goods for a retailer or a manufacturer, and definitely the biggest expense for a company that provides services or salaries. So in this example, let's assume you have $80,000 in salaries. Now you can start entering in all these other expenses. And like I said earlier, if these categories don't capture everything you have for expenses, you can always enter it in one of these 3 other categories down here. All the other categories you can't overwrite. And on these other categories, you can always check the help that pop up from the cells that have the red arrow up in the upper right to get more information. So now I'll fill in the rest of the cash outflows for this company. Okay, So now I'm done entering the operational cash outflows. And now I have both my operational cash inflows and my cash outflows to get my net cash from operations. And I recommend entering your operational cash inflows and outflows for all the periods before entering any financing or investing activities. Your net cash from operations is a critical number. It tells you if your core operations are producing cash for you or whether they're using cash. And if you don't have that cash in your beginning cash, you have to get it from financing sources. So now let me fill in the remaining operational cash inflows and operational cash outflows for this company before we start looking at the financing and investment cash flows. Now we've entered our net cash from operations for all the periods. A lot of cash flow projections don't include two critical categories of cash flows. That's the financing and investment cash flows. This company, from their cash from operations, have fairly consistent ending cash balances. But what would happen if there were large cash inflows? What would you do with all that cash? That's what you could plan with your financing and investment cash inflows and outflows section. Or how about the opposite? What if your cash outflows are massively negative and you need sources of cash? The financing and investment cash inflows and outflows sections could allow you to plan when you were going to draw on lines of credit or pay those back down. If you have large cash inflows, the financing and investment inflows and outflows section allows you to plan when would you do pay downs on loans or distributions to owners. So let's look at that a little bit. Okay, here's a scenario where the company has big negative cash from operations. This company needs to find financing sources to fund their negative cash from operations. So, what are some of their options? Well, maybe they have a line of credit. So, beginning in February, when their cash balances go negative, they decide to start drawing on this line of credit. So now they've drawn 50,000 a month during 4 months to bring their ending cash balance to a positive amount. This would be the sort of scenario analysis you do. Now they know the size of the line of credit they're going to need to survive their negative cash outflows. Okay, here's another scenario. This company now has large cash inflows from operations. In fact, their cash balance starts at $167,000 and grows to $712,000. They don't need $700,000 sitting in their checking account earning zero. They have many options for this cash. So let's talk about what some of their options are. One options is they could pay down a line of credit. Maybe they have a line of credit of $100,000. So in February, they decide to pay it down. Now they've paid off their debt, but they still have excess cash balances. Maybe they have term debt that they want to pay down. We could add the pay down of the term debt on there on some of their loan payments, like for real estate. My caution on that is make sure that you're never going to need that money when you make payments down on term debt because that's not like revolving debt where you can just draw the money back on loans if you need it. Maybe this is the time for them to invest in their operations and buy more equipment, or maybe invest in some real estate or make improvements to buildings. So maybe they decide to do some of that. So now we've added equipment and capital purchases, but still they have almost a $500,000 of cash at the end. Maybe this is the time to make some distributions to owners. So the owners can use that either for other investments that the owners have or for the personal spending needs of the owners. So now, instead of a $700,000 cash balance at the end of 6 months, we've identified that we could pay down the line of credit by $100,000. We could invest $150,000 in equipment or other investments in the company over a 3 month period. And in addition, we could distribute $25,000 to the owners over the next 6 months. Now, we could continue to do this. Maybe up in the operational cash flows, we decide to increase salaries to grow the company or make other investments in the operations. So, the power of a cash flow projection isn't entering numbers to make the best guess of what the future is going to look like. It's making your best initial guess of your cash from operations and also entering in any required financing and investing cash flows. And then after that, figuring out what to do to either use excess cash or find sources of cash to deal with negative cash balances to optimize your potential for your company.